Welcome to The Explainer. Today, we're going to build an investor's toolkit from scratch. We're going to break down some core financial wisdom so you can learn how to really evaluate a company's health right from the ground up.
Okay, let's start with this quote. The rich don't work for money. Their money works for them. This really gets to the heart of a powerful idea, one made famous in the book Rich Dad, Poor Dad. It's all about a fundamental shift in your mindset. See, it's not just about earning more. It's about making your money work for you.
So here's our game plan. We're going to build this up step by step, starting with that core philosophy and then diving right into the practical, nitty-gritty numbers you need to truly understand a business. All right, first up, the rich mindset versus the poor mindset. We've got to understand the two core ways people approach money, because you know what? It's not really about how much you make, it's about how you think.
So on one side, you've got the poor dad advice, something many of us grew up hearing, right? Study hard, get a good, secure job. The focus is on earning an income by trading your time for money. But the rich dad mindset? It's completely different. It's all about owning things that generate income for you. It's a huge shift from thinking like an employee to thinking like an owner.
And that brings us to the most crucial point, understanding what to buy. And that's an asset. So what is an asset? It's simply something that puts money in your pocket. Think stocks, rental properties, things that make you money even when you're not actively working. This is the engine of wealth creation, right here. And on the flip side, we have a liability. This is anything that takes money out of your pocket. Now here's the fascinating part. A lot of things people think are assets, like a nice car or even the house you live in, are actually liabilities in this framework because they're constantly costing you money. Really getting this difference is absolutely key as we move on to looking at stocks. Okay, so let's talk stocks. When you go to buy a share in a company, what are you actually paying for? Is it just that sticker price you see flashing on your screen, or is it something deeper? Getting this distinction is so important.
Well, first, we've got something called book value. Think of this as the bedrock, the absolute baseline value. It's basically what you'd get back for each share if the company just shut down today. Sold off everything it owns, paid off all its debts. What's left over for the shareholders? That's the book value.
Okay, so that leads to a pretty obvious question, right? If the book value is, say, 200 rupees, why on earth would anyone pay 350 for it on the market? I mean, that sounds like a terrible deal. But, well, it's not that simple. Because the market, it's not just buying the company as it is today. It's making a bet on its future. Right. Investors are willing to pay that extra cash, that premium, because they believe the company is going to keep doing great things. They expect it to keep making profits, grow its value, and maybe even pay out dividends. You're not just buying the present, you're buying a piece of its future potential. Okay, so we've got a handle on value. Now let's talk performance. Because the first most basic question you have to ask as an investor is super simple. Is this company actually making any money? And one of the best ways to answer that is with a powerhouse metric called return on equity, or ROE. This little number tells you exactly how good a company is at using the owner's money, that's the shareholders' equity we talked about, to generate profit. It's the ultimate measure of profitability from an owner's point of view. So, let's say a company has an ROE of 20%. That's fantastic. What it means is that for every 100 rupees of your money that's invested in that business, the company churned out 20 rupees in pure profit that year. Now that is your money working hard for you. And check this out. This chart is so revealing. You've got two companies, right? AB Textiles and DC Textiles. They have the exact same amount of assets, same factories, same machines. But look at the difference. AB Textiles is just way better at turning those assets into profit. What does that tell you? It points to better management, better efficiency, just a better run company.
So being profitable is great, but it's only one part of the story. The next question is about efficiency. I mean, a company can have amazing profits on paper, but if its warehouses are full of stuff it can't sell, that's a problem. So how quickly can it turn its products into actual cash?
For that, we use a metric called Days Sales Inventory, or DSI, and it's exactly what it sounds like. It's like hitting a stopwatch on a company's sales cycle. It answers that one simple question. How many days, on average, does a product sit in inventory before someone buys it? This little corner store example makes it super clear. So the owner stocks the shelves with, say, 5 lakh worth of goods. That's the inventory. It then takes 73 days to sell all of it. Then they restock, and the cycle starts all over again. A low DSI, a fast cycle, is what you want to see.
It means cash is flowing back into the business fast, ready to be used again.
Okay, we're building a pretty good picture. The company's profitable, it's efficient, but there's one more massive piece of the puzzle: debt. If a company is drowning in debt, that is a huge, flashing red flag. We have to check its financial stability.
And our go-to for that is the times interest earned ratio, or TIE. Think of this as your safety check. It tells you how many times over a company can cover its interest payments with the profit it's making. It's all about the size of its financial cushion.
Just look at this comparison. It's crystal clear. Company A is sitting pretty. It earns 5 rupees for every 1 rupee it owes in interest. It has a massive cushion. Company B, on the other hand, it's on thin ice. If business takes even a small dip, it could be in real trouble, maybe even unable to pay its bills. That's a risk you don't want to take.
So here's the takeaway for you as an investor. You're looking for that healthy buffer. As a general rule of thumb, a TI ratio of 3 or higher is a great sign. It means the company has plenty of breathing room to handle a tough year without getting into trouble. It's just a much, much safer investment.
All right, last piece of the toolkit. Let's figure out what it would actually cost to buy the whole shebang. Not just the shares, but the entire company, debt and all.
This is called the enterprise value, and it's basically the company's real price tag. Here's how it works. You start with the market cap, the total value of all the stock. Then you have to add all its debt, because if you buy it, that debt is now your problem. But, and this is the cool part, you get to subtract all the cash the company has on its books, because that cash becomes yours. Simple as that.
And there you have it. That's your toolkit. By combining these metrics, profitability with ROE, efficiency with DSI, safety with the TIE ratio, and its true value with EV, you get a full picture of a company's health. You're not just guessing anymore, you're making smart, informed decisions. Which, of course, brings us all the way back to the beginning and leaves us with one simple question.